This is the video lesson for you if you are seeing paper losses in your investment portfolio right now. Imagine scenario A, you invest into a fund and its price or NAV drops 20%. Scenario B, you invest into a stock and its price drops 20% as well. Looks the same, feel the same, but actually very different. Now, number one, let's talk about the root cause. In scenario A, root causes includes a change in the business landscape, in the macroeconomic environment, fiscal, monetary, and government policies. Maybe there's a war, a pandemic, or things as simple as investor sentiment. In scenario B, it could be caused by deteriorating company financials, PN17 status, or bankruptcy protection in Malaysia, or even an accounting fraud. In other words, events that is very specific to a particular stock or company. Plus, it could be also due to everything I've just talked about in scenario A. 3 examples that I'm sure you can relate to is number 1, AirAsia, 2, Top Glove, and number 3, Supply Dynamic. Now let's talk about the second point. What are the reasons that will make its prices recover? In scenario A, in terms of a fund, it could be an active fund like a unit trust or even passively managed fund like ETFs. It could be an optimistic direction change in the business landscape, in the macroeconomic environment, positive change in the fiscal, monetary, or even government policies. And then there could be an end-to-end war, the pandemic is ending, or it could be an improving investor sentiment. In scenario B, what could make the price of stocks recover? Now, it could be improving company financials. It could be a company that is getting out of the PN17 status, etc. In other words, again, events very specific to the company. Plus, everything in scenario A. In other words, whatever that affects the economy, the business landscape, could actually causes a very good company drop in price as well, at least in the short term. Now, it is entirely possible for a single company or a stock to never recover, even though the entire broad market recovers. BlackBerry is a good example of this. Now, see this, market shares were destroyed by Apple and Android, versus the S&P 500 in the same period. Versus any type of funds, which refers to a basket of stocks or even bonds, if it's one fund, invested into a selected sector or selected geography. And a fund is not subject to what I call as a concentration risk of a company or a business, a stock, unable to recover from its former glory days. And that is why they always say investing into stocks directly is always riskier than investing into any type of, say, equity funds. Number 3, what to look for to decide whether to buy or sell for a portfolio allocation or reallocation, or even a strategy repositioning. In scenario A, when dealing with a fund, you have to look at things from a higher level, like keeping up to date with the changes in the business landscape, the macroeconomic environment, fiscal, monetary, and even government policies. And if there is a war coming, or the pandemic is on the horizon, or there's a change, a shift in the investor sentiment, you generally want to be very aware and want to change your portfolio accordingly. Now, if it's in the scenario B, when it pertains to a stock, you need to know, on top of what I just mentioned in scenario A, things that is very specific to the stocks of the company itself, like the ongoing fundamental changes of a particular company. Maybe you want to look at the charts as well, what we call technical analysis. And there's things that affect the prices of a certain stocks, like quantitative trading. And today, we look at things more advanced. It's called alternative data. Now, if you do not know what I'm talking about, I want you to watch the next video coming up. Now, before that, let me cover about the 4th thing over here, about ways to handle this when you see stocks that has dropped 20% or even more versus a fund that has dropped 20%. Now, in scenario A, dealing with a fund that has dropped 20%, you could do a tactical or even a dynamic allocation or reallocation, like to increase or reduce exposure or weightage to equities or bonds or even money market at different cycles of the economy. Or you might want to actually hold for recovery, wait until the down cycle is done and then the up cycle begins. Now, in scenario B, when it comes to a stock that has dropped 20% or more, Well, you could either cut loss, keep on holding, or if you see that your profits were 50%, but now your profits is only left 20% because the price has dropped, then you might want to realize your profit and sell before it's too late. Now, example, in the year 2020, cut loss is not even the best investor I'm doing. You don't have like emotional attachment to any stocks. But at the same time, you know that when the market is down, institutional investors are also buying in, but only a particularly right stocks. Look no further than what this respectable CEO of Malaysian Civil Servant Pension Fund recently said. Okay, on to the next video.